Good afternoon, everyone, and thank you for joining us today. And welcome to Buy Properly's Q4 update. I think Kushbu, our CEO, will be joining us a little later in the presentation. In the meantime, I'm Colin Tu. I'm the head of product at Buy Properly. I oversee the development of our platform as well as the investment review of our new projects. So my goal is to make your investing experience as comfortable as possible while giving you the peace of mind in your investments. So a brief introduction about myself. I recently joined the company at the end of last year, and it's been very exciting working with such a dynamic team, a company that's really focused on providing customers with great investment opportunities. I previously worked in investment research at the home builder Mattamy, and before that, I spent a number of years at a large REIT, as well as another prop tech startup focused on global real estate investments. So I've been able to bring some of those insights to Buy Properly and incorporate them into their growing investment offerings. So it's wonderful to have a platform like this that makes real estate investments more broadly accessible to investors. So on the agenda today, we'll provide you with an update on the properties that you've invested in. We'll look at some of their operations and performances over the last quarter. And we'll highlight some of the upcoming projects that we have in the pipeline, which we're expecting to launch very soon, which we're very excited about. And we'll wrap up with a brief Q&A in case anyone has any questions. Just wanted to give a quick overview again, looking back at the end of 2022 there. So we saw the impact of the Bank of Canada's rate hikes really take its course through the real estate sector. And the market responded as expected with lower sales volumes and price adjustments. But this adjustment is actually quite healthy for the market by removing a lot of the excess and speculation that we saw during the pandemic. And this price correction really just takes us back to levels that were seen in mid-2021. And as prices continue to adjust, we will be actively looking for buying opportunities as the sector is now becoming a buyer's market. It's also worth mentioning that in the markets where these investments are located, over the last 18 years, there hasn't been a 5-year period where the returns were negative in the single family properties. So looking ahead, we are cautiously optimistic. After the quarter point increase from the Bank of Canada last month, it's our opinion that there will be much more careful consideration before any additional increases this year, if any. We think there will be a pause in rate hikes, but it is a balancing act as the central bank keeps a close eye on inflation levels and the overall economy. We're not expecting any rate cuts until early next year. The bank expects inflation to come down to around 3% in the middle of this year and 2% by 2024. We have seen longer term mortgage rates moderating, which may present some potential opportunities for refinancing as well. So with that said, let's take a closer look at some of the property updates over the past quarter. So, starting with Oakville, 20 Spears. We have a long-term tenant in place. It's currently rented at $2,450. It is cash flow positive, and we are expecting to make distributions by the end of February. Moving on to 60 Brandon Welland. Similarly, it's trending very well. We currently have it rented with a long-term tenant in place with rent totaling $3,550. That's up from $3,400 previously. There's no repairs or maintenance cost over the last quarter. And likewise, we're expecting to make distributions on this property by the end of February as well. Moving on to Hamilton, 50 Burton. We also have a long-term tenant in place in this property as well, with rental at $2,125. Utilities are covered by the tenant, and we expect distributions to be made on this property at the end of February as well. No, we didn't incur any repairs or maintenance cost during this period. Moving on to 511 Queensdale, also in Hamilton. We're also expecting to make distributions on this property by the end of February. It's currently cash flow positive with estimated value between 750 and 800,000. We have the new tenant in place starting in January. We did incur some minor cleaning expenses of about $700 to $800 in repairs and maintenance and cleaning costs just to facilitate the tenant move-out process. The property is rented for a total of $4,000 a month now, inclusive of utilities, which is higher than our initial estimate for the year. Moving on to St. Catharines, 641 Niagara Street. So this property, as of January, the property is rented at a total lease of $3,825 with a long-term tenant in place, and that's up from the previous rent of $3,550. So currently the net rent for this property is negative, and that's just due to the financing costs that we have in place there. We have negotiated the reduced interest rates starting next quarter, which will allow us to start distributions on this property, provided that there are no unplanned expenses. Looking ahead to London at 146 Wilson. The current rent is $3,700. Similarly, the net rent for Q4 was negative due to repairs and higher mortgage. There will be no distributions for this quarter. However, similarly, we have renegotiated interest rates, and we can expect distributions starting next quarter. Moving on to 101 Bailey in Ajax. So this property is trending very well. So the zoning package had received initial comments from the town of Ajax, and resubmission had happened in August. Secondary comments were received at the end of November and have been addressed with the city staff who've advised on the resubmission after the community presentation. So the third submission will be made in January with the council. And currently, it is currently the expected density for the project is 194 condo units, 4 townhomes, totaling 180,000 square foot in GFA. And in the meantime, our development partners, Yorkland Capital, continues to monitor the market and any impacts it might have on the development. Moving on to Ottawa, 390 Bank Street. So construction is progressing well at the project. Excavation has completed. The shoring has completed as well. They finished pouring the raft slab and working on the foundation and the parking levels as well have completed. So the project is still on track and slated to complete in March 2024. Moving on to Hamilton, 360 Lewis. So this Forge and Foster project, the building is almost fully occupied, and we have recently secured a tenant for $18 a square foot. So This is actually surpasses the developer's underwriting on the lease rates. And the project has progressed faster than expected, and they're working forward with their condo conversion plan. Moving on to Niagara and Switch Yards. While a few of their leases have ended earlier than expected, this actually presents an opportunity for the investment. The developer has already signed a lease for 20,000 square foot. And their planning team is in the process of severing the excess land on the site, which they hope to have it available for sale very soon. Moving on to our Glendale portfolio. So as of December of last year, the occupancy was at 94%. And the properties generated $215,000. So to date, 43 units have been renovated, and they're achieving an average rent increase of approximately $439 per unit. And this is above, renting at $38 above projected rents. So the sponsors, Rise 48, they believe that once interest rates begin to decrease in the second half of this year or beginning next year, cap rates will compress and property values will increase quickly. So by this time, they believe that they'll be in a great position with high net operating income in the properties, which will give them flexibility to either sell or refinance to return capital to the investors. So distributions will be made for this property at the end of February as well. Moving on to the Phoenix portfolio. So as of December of last year, occupancy rate was 87%. The properties collected approximately $495,000, which represents a 4% increase over the previous month, November. So to date, they've got 45 units renovated across the portfolio, achieving an average increase of approximately $455 per unit. And this exceeds their projections by an average of $78 per unit. Similarly, distributions are expected to be made by the end of February for this property as well. Moving on to Crow Valley Campground, another Forger Foster property. So they are well underway in their business plan. Currently, 3 of the cottages are currently ready for rent, and they're doing work on the remaining 4 cottages right now. They're also currently beginning to market the park, and will have the website up shortly. And last but not least, the Karma Candy building in Hamilton. There's been a lot of interest in this project, and the project is expected to close very shortly with the target close date by the end of the month. The developer has shortened the timeline for exit with a potential target exit of 18 months. So while this means a slightly lower equity multiple from 2.3 to 1.8, the investment is actually achieving a higher IRR of 47.6% compared to 25.5% previously. So, sorry, Kushbu.
Hi.
So looking ahead, we're always on the lookout for new and exciting opportunities that we feel will help our investors achieve their investment goals, providing you all with options to diversify across geographies, across the real estate spectrum, and across various alternative asset classes. So in the coming weeks, in the coming months, we will be bringing a variety of new deals onto our platforms, including different alternative investment opportunities. Just to highlight very quickly here. We've got a Beacon Diversified Fund in the pipeline, which offers a diversified set of assets, private credit, private equity, real estate, art, venture capital. And we have another offering that's based in the US, the US Sun Belt, which is income generating value add real estate portfolio in the US. We're also including ESG investing as well with our intentional impact fund. And we've got a structured REIT product that we'll be bringing online shortly with an outstanding historical record. So all investments that we're very excited about. So please keep your eyes peeled for those. We will be sending out updates as the projects get closer to launch. And that pretty much concludes the update for this quarter. Khushbu, if you have anything to add or if anything you'd like to add.
So we are very excited to have Colin. He comes with tons of knowledge and is helping us refine our due diligence and sourcing process overall. So very excited to have him on our team. He's influencing our tech, he's influencing our AI to make it better every day. So improves the quality of deals even more. I think in the last year, just like everybody else, we've been very cautious on what deals we add. That said, every downturn is also an opportunity. So we are looking to add a whole host of deals. But we've also spent last quarter or so refining our partnerships, refining our AI to do better due diligence. And so where we are at the moment, we have a whole pipeline of some really good quality deals coming for our customers. And we are very excited about that. These partnerships have been worked in for a while, and now we are at integration and legal agreement and going live stage. So excited that we'll be able to bring some of this. At a high level, the intent is to give our customers an opportunity to grow their wealth. That's what the platform does. And obviously, real estate is one of those options, but you also have the options of private credit and private equity. And those are the other two verticals that we are looking to bring in. We also have our proprietary AI models that can help people build automated portfolios if they would like. We are also trying to consolidate costs across our projects. So for example, for US deals, we are looking at larger portfolios where we as Canadian investors can get a lot of economies of scale when investing in US properties. Lots of good opportunities in the US. I think as a platform and as a company, our job is to allow our customers to make money. And so we will go where the returns are. In terms of the properties that we have, and there were a few comments, are we looking to exit 146? We actually do evaluate all our properties under our umbrella every 6 months to see if we should hold on or exit. Our typical hold is 5 years, and all our properties are in the money from where we stand. So we are not trying to exit. It's very easy to exit. That's the easy route out. But we know that even though the short-term cash flows look negative, in the long run, there is enough potential. The fundamentals are still strong. We've made a lot of the sourcing based on strong fundamentals, and that isn't changing. In the coming months, we want to take the most advantage of the opportunities in the market. There's a lot of fire distressed sales, which is making good assets available. And what has happened, sharing, because you guys are not just the customers, but also our champions and our supporters as a company, what has happened is because of the the market going down overall, lots of asset managers, big names, big funds are looking to work with us, which for us means it has opened up a huge supply of very high quality deals. Almost asset managers who wouldn't even take our calls or talk to us in the past, very large funds are now trying to figure out how they can work with us. So we are very, very optimistic about the pipeline and the quality of some really high-end deals that we will be able to bring in the coming months. So those are some of the company updates. We continue to refine our product and tech overall, but at the end of the day, the objective of the whole machinery is to allow people to make money. And so we're focusing. Yeah.
Okay. Well said, Kushbu. Sorry, just cut off there.
Yes. I don't know if people had more questions. I would like to hear more info on radio arts. If somebody wants more info on radio arts is something that's pre-construction. It is doing well, but again, it's pre-construction, so it's going to be a while. We've taken it from a good developer and a good broker. We are very confident it's a very high quality asset. All the fundamentals in Hamilton haven't changed actually. Hamilton is seeing even more progress, lots of tax holidays, government support coming in Hamilton. So very optimistic about almost all things Hamilton, to be honest. And then another question is, when will Q3 and Q4 reports be available, and when the tax receipts be issued? We are working on the tax piece. We know people need the tax receipts, so we will make sure they are available as soon as possible. I don't think I'm the right person to give you the exact date. The Q3, Q4 reports are already in work, so they will be available shortly. All of the numbers that we reported, usually we only hold our quarterly updates or shareholder meeting when we have a lot of information. What is the approximate minimum investment for these REITs? So we've negotiated with the REITs or any large fund that we are bringing to the platform, and it is always the same minimum as we have. So for the ones that are coming in at the moment, we have been able to successfully negotiate to lower the minimum to what we have. Those are all my updates, but happy to be answering any more questions if you have. I guess that's it. Thank you, everybody. Colin, anything else that you need to add to this?
No, I think that's it. I mean, we have a lot of exciting opportunities coming in the pipeline.
Yes.
But yeah, thank you, everyone. I appreciate you joining us today.
Thanks for joining, everyone. Bye.